Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. Okay, so my one chart for today is the financial sector, ticker XLF. So what's interesting is if you look at the relative performance of the financial sector, which is here at the bottom panel, you can see that since the beginning of the year, it's actually been in a relative downtrend for the most part. That changed in mid-May, but up until then, with the market sell-off, even with the market recovery, financial sector just could not start to outperform, just could not figure out a way to do it. And it rallied okay out of the low. So the only time that the relative strength stabilized was coming out of the March 23rd low. It sort of rallied in lockstep along with all the other sectors. And as you can see, recovered about 38.2%. That's that first Fibonacci retracement level that you see here in green. After that, though, it started to stabilize, break to new swing lows. This is as a lot of other stocks were continuing to improve in April and May, which is why the relative strength continued to go lower. But something really interesting happened about 3 or 4 weeks ago. The outperformance of technology started to back off a little bit. So the XLK, which had been a consistent outperformer, the relative strength started to turn lower. And to compensate for that, things like energy, financials, industrials all started to rally. So these are more of the value-y types of sectors that had been underperformers that now starting to emerge. The reason why it's my one chart today is because it's at a really critical juncture. It has now recovered just over 61.8% of the way, which means it's back above its last Fibonacci retracement level, which technically clears the way to retest the previous highs just above 31 on the XLF. What's happened, though, is now it's right above that 61.8% retracement level. It's also has failed now in the last couple of days. It's failed to eclipse its 200-day moving average. So now we're at a decision point. Is this momentum that we've seen over the last 3 to 4 weeks continue? And after a brief pause, we break above the 200-day moving average, which I would argue clears the way to retest the previous highs? Or is it unable to materially break higher above its 200-day moving average, breaks back below the 61.8% retracement level, which would clear the way to get back down to the 50-day moving average, also the 38.2% retracement level, which would be a bit of a pullback back to this range to in the April to May period. So right now it's at that key juncture. We've seen a rotation away from technology into financials, into energy. We're at that point where we need to decide whether financials continue to perform well, resume this relative uptrend, resume this breakout in price, and retest the previous highs, or if they find unable to eclipse the previous the 200-day moving averages, start to break to new swing lows. You know, if you had to ask me which one I would expect, I think we're going to get a little bit of both. I wouldn't be surprised if we get a bit of a pullback here, and that's because so many sectors are overbought, especially the broad S&P with an RSI above 70. Also, the technology sector, many stocks within financials and elsewhere all overbought, which suggests they've gone too high too quick, and you'd expect a bit of a pullback. But overall, the momentum has remained pretty positive, and as long as financial sector remains in a pattern of higher highs and higher lows, I think it's a pretty decent bet to continue to do well. But first things first, it has to eclipse its 200-day moving average, and that's why this is my one chart for today. This is Dave Keller with Market Misbehavior. Be well. Talk to you soon.